欢迎您观看红周刊的面对面节目，我是今天的主持人张小天。我们今天邀请到的是牛津经济研究院的2位专家，为我们分享美联储加息周期中的投资策略。他们分别是全球宏观策略总监克洛麦勒斯先生、全球股权投资策略研究总监格罗夫纳先生。牛津经济研究院起源于牛津大学商学院，距今已有40余年的历史。他们的经济与金融市场研究广泛服务于跨国性企业以及金融机构。It's great to have you here, Mr. Korominus. Now we know the Federal Reserve will do their best to fight against inflation, and they look very hawkish about the coming rate hikes. So question number one is, would they probably push the U.S. economy into recession?
Yeah, thank you. That's a very good question, actually. And I think one of the ways to try to answer that is to think about where we are in the cycle in the U.S. So obviously we've come out of the massive fiscal stimulus following the COVID downturn in 2021, which is also very strongly led by consumer demand in the U.S. In the last few months, we've obviously had the stagflationary shock to a certain extent, which has raised prices, but not in a traditional way. So it's come mainly from the commodity price impact leading to higher inflation, as opposed to being purely demand-led like in 2021. So the Fed has a real difficult task ahead when it comes to its interest rate policy. We think that at the moment, in understanding the cycle in the US, we're at late cycle. So looking at various key indicators, whether it's the Michigan Consumer Confidence Index, the Conference Board Index as well, looking at wage activity, looking at the strength of the labor market, looking at earnings momentum and equities, all those factors seem to suggest to us, looking at our internal models, that we are late cycle. So the Fed is going to be raising rates into a cycle that's already quite advanced, and so that could be a challenge in terms of tipping the economy into a recession. One of the things I have to say is we don't really know how long this late cycle will last. So typically it might last 6 months, 12 months, up to 18 months even. So there could still be some traction left in the U.S. economy, especially as consumers have relatively healthy balance sheets. So the question is now, if the Fed does go beyond the neutral interest rate, there is a possibility that we can be tipped into recession, but that's not really our base case at the moment. We think that the late cycle will continue for a bit longer. The Fed will have to perhaps reassess its interest rate policy further in the year. Maybe by the late summer, it may have to sort of think about whether it needs to pause or not. So one of the key things that we'll be looking at is the spread of the 2-year yield and the 10-year yield in the U.S. yield curve. Mm-hmm. And that spread needs to keep relatively positive for the Fed to be able to continue its interest rate policy. So, there is a chance that spread may go to zero, in which case we think the Fed will probably not continue hiking into after the summer, and that will perhaps then avoid a recession. So our base case is at some point the Fed will have to reassess its policy. The late cycle can continue for a bit longer, and we won't have a recession just yet.
Mm-hmm. Another thing we can't ignore is the Fed's balance sheet. It's huge. It's $8.9 trillion right now. So what does the Fed shrinking its huge balance sheet mean for ordinary investors?
Yeah, so we've been thinking about this for some time now, because we know that the balance sheet quantitative tightening is going to come. So we've had time to prepare, and investors have had time to think about this. The way I like to think about this is by looking at what QE does, and then we can understand what QT will do. So in getting to a very large balance sheet, the Fed is engaged in QE, but QE is not really good at creating inflation. The inflation we've seen now is due to commodity prices and other factors, really. For for many years we've had QE and it's not had an inflationary effect, but it has raised asset prices. And I think QE is relatively good for asset prices and for the general investor. So as the Fed winds down its balance sheet, so-called quantitative tightening, I think the reverse will probably happen. So it will have an impact on asset prices, perhaps, meaning there will be less gains to be had in markets, but it won't have a significant effect on decreasing inflation. In terms of the bond market, which is where we have a direct impact of the shrinking of the balance sheet, we need to look at how the US federal government is funded and what the Federal Reserve has been buying in terms of bonds. So we need to look at the supply bonds and the demand for bonds. And what we can see is that there will be a lot of bonds to be issued in 2022 in the United States. It won't be as big as 2021, but it will still be relatively large in terms of the level of issuance that the Treasury has to do. And that means that if we now take the Fed out of the equation because of quantitative tightening, and the Fed accounted for roughly 40% of issuance last year, that leads to a relatively large gap to be filled in the Treasury market. So at the moment, foreign investors into U.S. Treasuries have been not buying very much at the beginning of the year, but that's normal. That seems to happen. It's a seasonal effect. But again, we will need to see significant buying of overseas investors of U.S. Treasuries for yields to stabilize. So I think it makes sense for yields to go slightly higher from here. And then the implications for equity markets, I think, will be discussed by Dan. But I think as long as the rise in interest rate is not very fast, it will still support asset prices, but the gains won't be as large as they were in 2021.
Mm-hmm. So let's talk about China's markets here. When the Fed raising its benchmark rates, people are watching emerging markets like China. And we know China is stabilizing its economic growth with accommodative policies. In this situation, how would Fed's tightening moves impact or influence China's markets?
Yeah, I think from a macro perspective to start with, I think the key thing is that we're monitoring is as the interest rates begin to diverge, will there be significant capital outflows from China? And I think if the Chinese investors start putting their money abroad, that is something that it's going to be very important to watch for us. So I think the key to understanding this is to look at the renminbi. So the renminbi has been relatively steady against the dollar. Obviously, it's one of the best performing currencies this year. But the narrowing interest rate differential has actually not led to a significant capital outflow pressure. So that's our base case scenario. Obviously, we can't rule out actually the faster U.S. rate hikes might create bigger outflow pressure and therefore weigh on Chinese assets a bit more heavily going forward. But I do stress that obviously China's huge domestic savings and it has to some extent capital controls in place, so it can manage that exchange rate and still allow to have a difference in interest rate policy versus the world without triggering a significant capital outflow. So I think China is in the fortunate position that it can absorb some of those shocks given the capital controls.
Mm-hmm. As you may know, some economists and investors have been concerned about the status of US dollar, which is the most important reserve currency in the world. With major commodities denominated in dollar, the gains in their prices actually mean a weaker dollar. If the commodities continue to rise and inflation continue to rise, will the dollar's status be challenged?
Yeah, I think that's a good question. That's one that investors need to think about on a longer term perspective. Yeah. So all currencies rise and fall over many years. So and the dollar is the most dominant currency in the world, and it won't last forever, and we know that because of history. And so then the question is, how long will the dollar's reserve currency status last? And it can last for a very long time. And the reason is a reserve currency status is determined really by three things. The first is that the US has issuance of the largest supply of safe, risk-free assets in the world. So the treasury market is the deepest and most liquid market in the world, accessible to any international investor. So if a country aspires to be a reserve currency, it has to internationalize its debt market. It has to make its currency freely available to trade in ample liquidity across the world. The second factor that means that US is dominant, the dollar is a dominant currency, is the fact that the US is the largest economy in the world, and that's always been the case with reserve currencies. And finally, we can't ignore the fact that the US has the largest military presence in the world as well. So those are the three things, if you look at history, that determine what a reserve currency status is. Now, will the renminbi be able to achieve those three things? Well, certainly it can be the largest economy in the world, and certainly can have the largest military in the world. That's up to China. I think for me, the key thing is, will China be able to internationalize its debt markets much more and make it a key cornerstone for international investors to hold Chinese assets? I don't know what the answer is to that, but it's up to China if they want to do that. But that would be certainly a key condition for a reserve currency. As long as the supply of US treasuries is global and is backed by being the largest economy in the world, that's what determines a reserve currency. So I think in the next 5 years, we will move to maybe a multi-currency world where you have the dollar coexisting with the renminbi and perhaps the euro as well, in a multi-currency framework. And that actually is good for investors, because it means that you won't have competitive devaluations among currencies. So these currencies will have to compete against each other to preserve value, and that could be good from the perspective of an international investor. So I don't think the dollar's reserve currency status is yet finished, but it's certainly being questioned, and it will take a few years for that to change.
Yes, thank you. And I think I have several questions for Mr. Grosvenor. We know after the Fed announced 25 basis point rate hike on March 17th, the markets did not seem to be frightened. In short term, actually, the stock market was optimistic. Why was that?
Yes, I think it was a sort of classic case of sell the rumor, buy the fact. So what I mean by that is that, this rate hiking cycle has been quite well telegraphed over the past few months, ever since the Fed's hawkish tilt in December, and equity markets had actually already derated quite significantly in anticipation of higher interest rates. So if you take the US, for example, the S&P 500 at the beginning of the year, it traded on a forward P multiple of about 21 times. That's come down to just over 19 times today. So I think we went some way to pricing in the tightening cycle, even if it does end up being quite an aggressive tightening cycle by historical standards. So I think that meant that once we actually got to the event, equities were already sort of well positioned for it.
In this rate rise cycle, or also an inflation cycle, compared with other assets like bonds or real estate, what do you think of stocks? Should investors increase or decrease their stock holdings in their portfolios?
So we still have a small overweight on equities relative to fixed income assets. I mean, we have been trimming that allocation over the past six months or so, but we do still see upside for equities from here. And I think there's a couple of key reasons for that. One, as I mentioned, we already have seen a bit of a derating of equities over the last few months. Second, we're still fairly optimistic about the global growth backdrop. So, clearly global growth is slowing, as Javier mentioned, but we don't see a recession over our sort of tactical forecast horizon. That suggests that you're likely to continue to see fairly decent earnings growth from global corporates, and that should help to drive equity markets higher. And then the final point I'd make is that if you look at relative valuations, so if you compare equity earnings yields to the yield you can get on bonds, they still favor equities. So equities still look attractive when you compare to fixed income assets at this point.
Yes. According to your research report on the sector's level, I think you are bullish about energy sector because you think the oil price will continue to rise. So my question is, how sustainable is the current level of such a high oil price? Is there some downside risks we need to watch out for?
Yeah, sure. So we don't actually see the oil price rising much further from today's levels. I think when we wrote the report that you mentioned, we were in the mid-90s. Obviously now we're closer to sort of $120 per barrel. But what we do see is oil prices staying above $100 a barrel throughout most of this year, maybe dropping into the mid-90s but by year end. And I think that in itself should be enough for the energy sector to continue outperforming. So it's one of the few sectors at the moment that's seeing strong upward EPS revisions. And if you look at oil companies, they're generating a significant amount of free cash flow at the moment. And I think that means they're able to distribute some of that cash to shareholders in the form of dividends, in the form of share buybacks. And that's something that we think is going to be well rewarded in this environment of higher rates. In terms of the risks, I guess the most obvious risk to the oil price would be a sort of sharp slowdown in global activity, a decline in the demand for oil. As I said, that's not our baseline view, but perhaps recession risks have been rising over the past months. There's potentially also some risks on the supply side as well. For example, if US producers ramp up their production much more quickly than we expect, then that clearly could have some downward pressure on oil prices. Again, that's not our view. We think the supply response is likely to be much more muted today than it has been in the past. US producers have a continued focus on capital discipline at this point in time. And there's also actually some labor shortages that are just limiting how much they can ramp up activity. So as I say, we see a sort of gradual path lower for the oil price from here, not a collapse. And in that environment, we think the energy sector looks still quite well positioned from a relative perspective.
Yes. And we also know you are actually kind of bearish about the IT sector, but you also said in your research report that the rate expectations in the US have peaked, and that may help calm the investors' nerve. So given the tech stocks, tech names have fallen a lot in recent months, and we have seen a NASDAQ correction. So is there a buy the dip opportunity?
Yeah, sure. So we have been underweight tech for a while. The reason for that was we felt that valuations were too expensive, particularly in the context of rising rates. And obviously you're right to say that those valuations have come down sharply, but we still do think it's too early to buy at this point. So if you look at the sort of global IT sector, the valuation multiples are still about 2 standard deviations above their longer term average. and the sector still looks the most expensive global sector on our valuation framework. On top of that, I do think there's some possibility for some earnings disappointment within the IT sector as well over the next few quarters. So obviously what you've seen over the past couple of years is that the pandemic and the lockdowns that we've seen, they pulled forward a lot of demand for certain IT products. And actually the consensus seems to be expecting that growth to continue even as countries come out of lockdowns and things go back to normal. So we're a bit more cautious. We think that growth rate is likely to moderate as sort of spending patterns revert back towards pre-pandemic trends. Slowly, of course, but we're heading in that direction. But also as activity slows more generally. So remember that the tech sector in aggregate is still quite a cyclical sector. So as a sort of global growth slows, earnings growth is likely to slow down. So I think that combination, still quite elevated valuation multiples, coupled with fading earnings momentum, that means that we're underweight. And obviously, if bond yields do continue to rise from here, that doesn't help the sector as well, because it's a very long duration sector, and by that I mean it suffers from a relative perspective as bond yields rise.
Mm-hmm. Actually, we know within the IT sector there are kind of two types of companies. One is internet company like social media companies. The other is hardware technology like semiconductor or something like that. Is there any difference between them?
So the hardware side, the semiconductor side, that does tend to be much more cyclical than the sort of software side, because it's the software side where you have the very high sort of expected growth rates, and much more stable growth as well. So we're cautious on the sector overall, but in terms of things like the correlation with bond yields, that does differ a little bit within the sector. So it's those software names that are most vulnerable to a rising discount rate. Whereas the sort of tech hardware and semiconductors, they're a bit shorter duration, that they're more vulnerable to sort of changes in global growth.
Yeah, and we know you are quite optimistic about the growth to value rotation, which we've seen for a while. In addition to energy sector we mentioned above, which other sectors are you bullish about?
Yeah, sure. So we do think value will continue to outperform in the current sort of inflationary environment. And if you look at the valuations of value stocks, that they still look attractive. So if you look at the sort of P ratio of the value universe overall, that continues to look very low relative to growth. Particularly when you compare it to what that discount looked like historically. In terms of the specific sectors, obviously energy, you mentioned, we also have a small overweight on industrials, and we have a heavy overweight on healthcare. Now actually, healthcare might not sound like a traditional value sector. It does have quite high and stable growth rates given sort of demographic trends, but actually it's increasingly showing up in value baskets and on value screens, and we think it's a sector that's quite well placed to outperform because it's quite defensive, which obviously if growth is slowing, that's quite attractive, and it's also got very strong balance sheets. So there's little solvency risk there as well. I guess the final sort of value sector, big value sector, is financials, and that is a sector that we were overweight on earlier this year, but we have just cut our allocation to neutral in our latest global asset allocation update. there's a couple of reasons for that. I guess the first is partly because we felt it had become a bit of a crowded trade in recent months. So our sentiment indicators suggested that there was a lot of optimism towards financials. Normally that's a bit of a sort of warning sign from a contrarian perspective. But on top of that, we do think that yield curves are likely to remain relatively flat from here, as Javier said. And although financials do benefit from higher yields, what they really need is a steeper yield curve, because that's what helps banks' net interest margins to expand and helps boost profitability in the sector. So if the yield curve remains very flat, higher rates might not necessarily translate into higher profitability for financials. On top of that as well, loan growth, particularly in the US, has been quite lackluster in recent quarters, despite the economic recovery we've seen there. So overall, earnings growth is likely to slow quite sharply in the financials this year. And I think in that context, we just chose to take some profits. So we're not negative on financials. We still like value as a concept overall, but we do think there are better opportunities elsewhere at the moment.
You mainly mean banks when you talked about financial sector.
That's right. I mean, so if you look at the sector globally, banks is the most significant component of the financial sector. Its weight sort of dominates the sector. So that's really what drives the sector overall.
Mm-hmm. Yeah. And that's all of my questions. Thank you very much. And we look forward to seeing you in Beijing maybe in the future someday.
That would be wonderful. Thanks for inviting us to speak with you today.
以上就是今天采访的全部内容，感谢您的观看。您也可以在各大新媒体渠道关注《证券市场红周刊》的更多内容。再见。